Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, in today's investment landscape, in this crowded jungle of too many mutual funds, it's difficult to zero in on the ones that are best suited for your portfolio. There is a problem of plenty. There is a need to declutter. In today's episode, we'll discuss how to do that and more with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
This problem of plenty that we're talking about. So, how do index funds figure in this scheme of things? And first of all, let's begin with what are index funds?
To understand index fund, you should know what is index. And most people understand what index is. Market goes up, you hear the news that the Sensex went up by these many points or it went down by these many points. As there is far greater awareness about index, I hope that people understand what an index is. That index is aggregation. It's a collection of stocks in a certain proportion. And it has far greater understanding. And most mutual funds are sold on the premise that, I will beat the index. I will generate more return than index. So index per se is about the market. It is generally assumed that the return that you get from index, academically speaking or theoretically speaking, it is what the market generates. That is it's the unmanaged portfolio. If you invest in that and that goes up or goes down without much of an effort. So this is what an index fund is. A replica of the index as an investment portfolio is an index fund.
All right. What are the advantages and disadvantages of index funds?
One is that, it's simple. You know what exactly it is. It is predictable. Nifty is 50 stocks. Sensex is 30 stocks. Junior Nifty is number 51 to number 100 stocks. Then the mid-cap index, you know what mid-cap index is. Constituents are frozen. It's decided. And your investment performance is exactly as the index. No more, no less. No disappointment. Did you beat the index? No, you matched the index. Did you underperform the index? No, you matched the index. So, you give up on beating or underperforming and settle with the average, and that is what an index fund is. So advantage is simplicity. And the second advantage is that cost. Most index funds are relatively lower cost simply because it does not require a fund manager to manage it actively. Besides that, all the other advantages of a actively managed or a mutual fund definitely continue, that you get diversification. You get the convenience, you get the tax efficiency. So all those things are there. But I'm saying that the special advantage that you get is the predictability and simplicity and the low cost.
Okay.
When it comes to disadvantage, the biggest disadvantage or, what actually does not strike a chord with people is that I invest in equity to beat the market, to do something substantial. And here is something, which you are settling to be an average. So settling to be an average is a choice which you have to make, which you invest in it. For that simplicity and low cost, you get this. Second is that, sometimes these indices are created in such a manner that the larger winners, the heavyweights actually dominate the index because they're mostly capitalization weighted, the big index I'm referring to. Then the third thing is that, sometimes that, okay, these are the losing companies. They are understandably going to lose the, plot or, it's on a losing streak. But still, the index fund has to hold it because it is not supposed to do anything except replicating the index. So you can see a loser part of the index and it is, widely known. Everybody knows it, but the index fund will own it. Heavyweight, dominating this. So these are the 2-3 disadvantages.
All right. Now, coming to how can investors use index funds in their portfolio?
Most investors can very, nicely use these index funds to their advantage. Even if you like actively managed fund, still one should use it for a specific reason. One is that, every portfolio, any investor's portfolio, should have equity as well as fixed income. Likewise, every equity investor's portfolio must have substantial large cap. And when it comes to substantial large cap, it could be 50%, it could be 70%, it could be 40%, but this much it should have. And that 40%, 50%, 60% should be stuffed with index fund, because all said and done in the large companies, it is very difficult to beat the index. And mutual funds are struggling, at least the large cap funds are struggling to beat the index. So what you can do is, if you actually stuff your portfolio with 40% or 70% into large cap, there's a guaranteed cost saving. And the likelihood of outperforming is small. Even if they beat it by 2%, 3%, because first and foremost, the cost advantage, assuming it is 1% or 0.75%, then the actively managed fund has to generate 1% more to match the return. Then comes outperformance. So I would say that most investors will be well off by stuffing their portfolio with a Nifty and a junior Nifty, or Sensex or a junior Nifty, or something like that for their large cap portfolio. And I think supplementary thing, then you can go ahead and buy your small cap, then go ahead and buy your multi cap, and then buy one or two sectoral fund if you are very kicked about it. So this could be one way. On one hand, you are ensuring that you will beat a good part of your portfolio will be very low cost.
That's about index funds. Now, moving on to the viewers' questions. We have two this time. Mr. Khan says he's a mutual fund investor, 78-year-old. His only son and his family depends on him for a monthly pension of 1 lakh rupees. Now, if you could explain how can he insert his son's name as a second holder instead of nominee with an option of either or survivor, and add some other nominee. So this is to make easy transactions after he's no more there.
It's complicated, but it's not impossible. Ideally, one should be investing at the time of investment, putting a nominee, putting a either or survivor mode is not that difficult. I could be an owner and another person, my spouse could be an owner. We could be jointly owning an investment. Right. So that is pretty straightforward. Here is also quite understandable that he wants to add, and it's possible. There's a change of, request change form, which this cannot be done digitally. He has to get in touch with the two registrars, because one of the two registrars will be, or either, depending on his investment spread over Karvi or CAMS, either. So a request change form. And he should make sure that his son is KYC'd, all those things, compliances are in place. And once this is done, he should put that request as a second holder with his signature and other things. And then he will get an acknowledgement and it will be done.
Okay.
It will be affected.
All right.
But this is a manual process. He will have to visit these places or get that form and sign it and duly, make it available to them.
Okay. Now there's another question. This person asks, what is the best method to take a tactical call for getting the benefit of likely ensuing interest rate cut? Should we invest in government securities funds or long duration funds now, or through an STP for next 3 to 6 months? If you could guide him there. He already has about 25 lakh rupees invested in short-term debt funds for about 3 years, and the annual returns are about 5.5% to 6%.
If you are convinced of this, and if you are prepared to be prepared for, going wrong, then, the long duration funds are the best bet, or the government security bonds, because, government securities, long duration funds, long-term gilt funds, they're the best bet because, whenever there's a rate cut, gilts are the first to reflect that change.
Right.
And at a speed.
Okay. All right then. That's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.